Denis, we welcome you to the podium of Camden Conference. Thank you.
Thank you, Graham, and thank the conference for inviting me to participate in this important and timely event. This morning I met Sam Felton, whose job it's going to be to help put my remarks in a form that they can be published in the conference results. And he said that I was the only person who had furnished a text prior to coming up to Camden. I said, Sam, for God's sakes, don't use that. That was done 2 weeks ago. This has been completely rewritten. I mean, things are moving fast. So I'll provide a new text. And I am kind of tied to this text because things, as I say, are moving pretty quickly. I was down in Key West recently when Buffett was reflecting on the state of the economy. That's Jimmy Buffett, by the way. He presented his analysis in a new song still in the works called "We've Got a Lot to Drink About." Don't we though? Don't we though? Before heading south a couple of weeks ago, I assumed naively that I would be among the first to bring to Camden the information or the news that the global economic crisis is a looming threat to U.S. foreign policy interests in the world. Imagine my surprise when I learned from the New York Times on February 12 that Denis Blair, Director of National Intelligence, had told the Congress that global economic instability had surpassed terrorism as the most urgent threat facing the United States. And that has a lot to do with radicalization, as Tamara was talking about earlier, and instability, fueling government changes, perhaps inciting civil and regional wars, the whole thing. Now, while I regard our intelligence services as a vital national resource, and their retirees are a vital local resource in Camden, I've often found their economic analysis to be no deeper than the ice on a pond in South Florida. This time, though, the analysts have probably nailed it. So in the light of current circumstances, what are the principal questions we might try to address? They are, first, how did we get into this mess? How did it spread? And how can we extricate ourselves from it? Now, this conference is not about the domestic economic situation, so I will limit myself to a few observations and recommend further reading for those who are interested. Second, we need to talk about the fragile state of the global economy and what can be done to shore it up. Finally, we should address the question implied by the title of my talk: how does the fact that the U.S. economic model faltered, failed, affect our broader foreign policy interests? Let's start with the mess we have on our hands. I assume that we are all reasonably well informed about the multiple causes of the U.S. financial and economic meltdown, at least to the extent that they are, limited extent that they are currently understood. If you will indulge me, however, I would like to call your attention to the analysis of Michael Lewis, who some 20 years ago wrote Liar's Poker, a devastating critique of risk-taking at Salomon Brothers. According to Lewis's current take on matters financial, when Salomon subsequently went public and former partners began making bets with other people's money rather than their own, things got even worse. To put it bluntly, shareholders became bag holders. Following Solomon's example, the rest of the Wall Street investment banking community cashed out as well. We know how it all turned out, or do we really, even now? At the heart of the economic meltdown, where Wall Street and Main Street are joined at the hip, is the failure to have lived within our means. In addition to weighing on labor and manufacturing, U.S. trade deficits, which could have been curbed by more prudent fiscal and monetary policy, were a key factor in creating the oft referred to global savings glut, a pot of money which, when loaned back to us and others by its foreign holders, notably China, Japan, and the oil producers, provided much of the liquidity, the cash, that permitted, or perhaps the better word is encouraged, dangerous leveraging by individuals, families, and financial institutions. Leveraging is taking $1 and betting 20. It's a dangerous practice. There's plenty of information out there on how we got into the situation we now confront, but I particularly like an essay by New York Times reporter Jeff Madrick that appeared in the February 12 issue of the New York Review of Books. It is entitled, "How We Were Ruined and What We Can Do." Full text at nybooks.com. We are now going through a painful correction, but we don't want it to be too painful. Thus, there is a near consensus among economists that the economy must be kept afloat with massive government spending and by printing money. This raises two central issues. First, on the fiscal side, can we actually achieve the desired stimulus? We have a $15 trillion economy, or at least we did until recently. What would it take to jumpstart it? The Congressional Budget Office estimates that the recession could drive a $3 trillion hole in the economy, based on certain assumptions about how deep the recession will be and how long it will go on. My only point is that it will take a lot of stimulus to fill a hole of that size. Second, on the monetary side, how will the Fed know when to shut down the printing presses? If the Fed does not get it right, we face the risk of a monetary overhang that will result in high inflation and other undesired consequences. Crash of the dollar might be one of those. I don't know about the members of the audience, but I have yet to hear a reassuring explanation of how we plan to unwind the unprecedented measures we are already taking, and which we seem poised to ratchet up significantly. Some of my friends, actual economists, with far more experience than I have, tell me that reversing a monetary expansion is not that difficult. Just sell the assets acquired in the downturn at the right time and at the right price. Skepticism. Next question. How is it that the global economy seized up at the same time that ours did? And frankly, I don't think we know the full answer just yet. Of course, our non-bank banks, the unregulated banking sector, created what became toxic assets, and these assets migrated around the world. But that's not the whole story. The global savings glut affected many countries. Thus, there were housing bubbles in Ireland, Spain, and the UK. And then there's the problem of Iceland. Iceland borrowed too much on unfavorable terms and placed it in the wrong places. Perhaps you've heard the joke What is the capital of Iceland? Answer, about $10. Just as in the US, many foreign banks were over-leveraged and undercapitalized. Even countries that curtailed the inflow of foreign capital, like India, have been affected by the global meltdown. At this point, I'd like to transition to say a word about U.S. international economic policy, such as I knew it from the mid-'70s to the early '90s. I spent the bulk of my career in the Department of State promoting the free trade and free market model. At times we were working against the grain. Balance of power enthusiasts like Henry Kissinger, but he wasn't the only one, were trying to game the system for national advantage. These folks, I assert, were virtually clueless about how the global economy works. I was then, and still remain, convinced that the values we in the economic game espoused promoted U.S. political objectives. It was, in those early days, Cold War-oriented, but it continues to have value. We had a plan and a vision that was going to, and for a long time did, make our country wealthy. But the important thing was that this objective was not achieved at the expense of others. It made our partners relatively wealthy too, and it made them friends of the United States. Deep theory aside, the whole idea can be easily grasped in terms of Henry Ford's insight that he had to pay his workers enough so that they would be able to buy the cars they were building. So I was struck when I picked up my copy of the January-February Atlantic and learned that Benjamin Schwartz, the literary editor, had decided to fill in his readers on Global Trends 2025. We've already heard mention of that. It's a publication of the National Intelligence Council and available on the web, as Nick pointed out. A key observation of the report concerns the unprecedented shift in relative wealth and economic power roughly from west to east. Schwartz opines that, quote, the problem with a giant zone of peace and prosperity is that it bites the hegemon that feeds it. By augmenting the wealth and power of multiple states, the United States spurs the relative decline of its own power. Now, this has implications for diplomacy, military, and other things. But on the economic side, my view is that the proper conclusion to draw is that the U.S. was not sufficiently forward-looking to lead the international community to install systems of governance necessary to manage the bounty that we, the United States, had created. But on further reflection, perhaps the key question for looking forward is whether the de facto hegemon, Uncle Sam, can learn to play with others. And more about this in a minute. Against the backdrop of Mr. Schwartz's take on Global Trends 2025, and somewhat in counterpoint, former Deputy Treasury Secretary Roger Altman observed in his recent Foreign Affairs article that, quote, the economic credibility of the West has been undermined by the crisis. This is important because for decades, much of the United States' influence and soft power, which we've been talking about, reflected the intellectual strength of the Anglo-Saxon brand of market-based capitalism. But now that model that helped push back socialism and promoted economic reforms in the UK and Eastern Europe is under a cloud, I would add, to say the least. The U.S. financial system is seen as having failed, and we are going to pay for that in terms of our global influence. When I shared some of my dark thoughts about the global economic situation with a friend and former mentor, a senior trade policy official, he reminded me that the U.S. remains one of the most dynamic societies on earth. The U.S. is a country of opportunity and a meritocracy that gives anyone the possibility for success. In other words, he says, we have the ability and the means to work our way out of the current problem. And I agree with that. But how long will it take, and what will it cost? We don't know. The blow to U.S. economic credibility and our resources is serious, but perhaps not dire. In the meantime, is there any good news for foreign policy in what we are confronting? One thought I had to augment Nick's observations this morning was sparked when a banker friend remarked after his firm had been bailed out that we are still in business, but we don't know how to make any money. If the collapse of Wall Street encourages our best young people to seek careers elsewhere, including in public service and the foreign service, that would be a modest plus. Very modest, but still a plus. And if executive compensation flattens, that would be good too. Another plus is a nascent rediscovery of the need for nations to act collectively to resolve global problems, sparked by the realization that economies worldwide are not delinked, as some thought until recently, but have been rather tightly coupled. Let's start with finance. As Nobel laureate Paul Krugman has explained, and here I paraphrase, we have to think hard about how to deal with financial globalization. In the aftermath of the Asian financial crisis of the 1990s, there were some calls for long-term restrictions on international capital flows. Instead, a strategy emerged of building up large foreign exchange reserves. Thus, we now know didn't work. For countries like Brazil and Korea, after all they've done, they're going through the 1990s crisis all over again. Financial globalization, Krugman points out, has definitely turned out to be even more dangerous than we realized. Now, there's no unilateral U.S. solution to the global economic crisis, chastened perhaps by the consequences of invading Iraq without adequate justification, adequate means, and only token support and little understanding of the regional implications, and with a revived sense of reality, untainted by wishful thinking, the wishful thinking that accompanied the launch and pursuit of the Iraq misadventure. The Bush administration was quick to respond to the European call for an economic conference and quite correctly rejected the notion of a G7 meeting in favor of convening the G20. At the mid-November G20 summit, important goals and objectives were agreed and follow-up was initiated. The final results remain to be seen, and with a follow-up summit in April in London, we'll get a look at what progress has happened. But I judge the original G20 meeting to have been positive, in other words, a good start. Others with whom I've spoken about this are a bit more doubtful about what was accomplished. There will be more power sharing in whatever emerges in the way of a structure to manage the global economy, particularly on the financial side. This is long overdue, and despite the operational difficulties it will entail, power sharing will be, on balance, a good thing. The G8, a long-standing anachronism, in my view, and I attended the founding meeting of the original G5 at Rambouillet in France in 1975, is toast. G8 equals toast. It's going to continue to meet, however, given the power of bureaucratic inertia. The G20, we've been talking about that, is a body far more representative of the current global distribution of economic power. Its defect is the obvious one, and that's already been alluded to. It's larger. As the late George Kennan, scholar and diplomat, once pointed out, quote, the unlikelihood of any negotiation reaching an agreement grows by the square of the number of participants, unquote. Something to bear in mind. We'll see if the G20 can do what needs to be done. Will a new global system of economic governance emerge in the near term? The answer is no. The best that can be hoped for is harmonization of national financial actions, stimulus actions, and re-regulations so that they don't conflict with each other, and something that will avert a race to the bottom where some countries under-regulate and unfairly, quote unquote, attract capital. So that sort of minimal objective is a very, very tall order indeed, as I see it. There are other institutions at the disposal of public policymakers. They included the World Bank, which can buttress the efforts of the IMF to provide financing to the developing countries. The outfit with which I was associated, the OECD, will be a venue where the developed countries and others come together to plot their way out of the crisis. The OECD's outreach to the so-called BRIC countries, Brazil, Russia, India, and China, plus others, will engage them in the exchanges of views and dialogue about lessons learned and the path forward that will, we hope, underpin efforts to put the global economy back on a path to vigorous growth. There is more to the economic governance than finance. Consider trade. As has been pointed out to me, one of the key challenges facing the world trade community down the road will be the manner in which the various bilateral and regional trade agreements are consolidated. There are some 400 of these bilateral and multilateral free trade arrangements. They need to be put together into one piece, and perhaps that result can be used as a basis for a broader free trade arrangement in manufacturers, some areas of services. And where do we stand on trade matters today? A New York Times reporter recently commented that trade is down a fair amount and that a 66% drop in trade is what made the Great Depression great. Now, we're not there yet by any means, but evidence, such as Buy America, such as our infusion and French infusion of capital into the auto companies that discriminates among other non-American or non-French makers, and a variety of other things, suggests that we risk heading down the path of protectionism and that it is a growing threat. Of course, it's one that emerges in any economic downturn, but this one is so severe that the threat is worse than one might have expected. The Doha round of the current multilateral round of trade negotiations is somewhat in the doldrums and needs to be either replaced or bolstered. The Obama administration is not particularly well placed to bolster because it's having to deal with its trade rhetoric during the campaign. I think the president's trip to Ottawa was a good start in kind of backing away, moderating, shaping his message on trade, and I hope that evolution continues. There is a broader issue involved in how the U.S. will engage in improving global economic governance. That is American exceptionalism, how we see ourselves. It may be a problem. Instead of recognizing the merits of pooling elements of our sovereignty with other members of the global community to achieve better governance, we are a country that relatively recently articulated a policy of preemption, which was doubly dumb because it didn't have to be stated. You can preempt at any time, and because it needlessly infuriated others. A rare piece of good news on the international economic front was already alluded to. That is the falling price of oil, and it's momentarily impaired the adventuresome Chavez, Putin, and Ahmadinejad. With crude now hovering well below recent highs, they are smaller autocrats, this is quoting from the Wall Street Journal editorial page, sitting atop wobbly regimes and distorted economies. Good news indeed, although the journal's editorial page seems to me to be singularly bereft of sound ideas about how to benefit. It has many good ideas, but how to benefit from what is surely a temporary pause in the rising price of oil. The fundamental energy policy problem is that any serious attempt to lessen dependence on foreign oil, Canada excluded, of course, means that the price of transportation fuels must increase and be stabilized at higher levels. Well, in the midst of a severe recession, government action to bolster energy prices seems highly unlikely to me. What about our image and influence? U.S. credibility and our diminishing stock of moral authority are already severely undermined by Iraq, has suffered another severe blow due to the economic and financial crisis. It appears to the world, very broadly speaking, that we are not so good at the things we were supposed to be good at, exercising military power and running an economy. On the economic side, the restoration of our credibility will be an uphill climb. Case in point, the United States and the countries in the Eurozone have bought major stakes in their banks. Britain has nationalized a couple. And we, meaning the taxpayers, may end up owning a fair share of banks ourselves. In the US, we have taken partial ownership of the auto companies that failed to mend themselves in the wake of trade restrictions imposed some 25 years ago. I was implicated in that policy failure, the only virtue of which was that by scaring the auto exporters, it led to the creation of auto transplants, that is foreign investment in the US in the auto industry, that up to this point have created a viable industry right here. If President Obama inherits a $1 trillion budget deficit and temporarily enlarges it to $2 trillion, there will not be much of a constituency calling for increased U.S. foreign policy spending. It may it may prevent the rebuilding of State Department finances and personnel resources. It's something that badly needs to be done, as we've discussed earlier. It may also delay the reconstitution of our foreign development infrastructure. The $500 billion reconstruction fiasco in Iraq owes much to the fact that we long ago sidelined much of our development expertise. Here, just as an aside, let me say that trying to convert the Department of State into a nation-building enterprise is one of the least appealing ideas I've heard in a long time. There are other, better ways to respond to the need for nation-building expertise, and one approach would be to reestablish USAID as an independent agency and beef up its staff and resources. The Obama administration is going to have to focus on the domestic economy, but issues, tough issues, the foreign policy issues that we've been talking about, are going to force themselves onto the presidential plate. And of course, these things are interrelated. To the extent we succeed in reviving our economy, our ability to lead in foreign policy certainly will be enhanced. Harking back to the National Intelligence Council's observation that economic power is shifting from west to east, let's consider U.S.-China relations very briefly. My crystal ball is cloudy. The crisis can worsen our relations, maintain them roughly as they are, or even lead to an improvement. For openers, let me recall that in the late 90s, we lauded the Chinese for maintaining their currency peg to the dollar while other nations in Asia were devaluing. We were right then, but we are also right in 2009 when we call for an upward valuation of the yuan. I won't go into some of the problems of accomplishing that in the current environment, but they're perhaps obvious. Chinese Foreign Minister Wang has pointed out, quote, "The teachers now have some problems," unquote, indicating that our ability to influence and persuade the Chinese to do the right thing with their currency has been undermined. The Obama stimulus package means that we will be borrowing vast new sums from China and other foreign countries. The current U.S. public debt of some $10.7 trillion is by no means insupportable, but the comforting notion that we owe it to ourselves no longer fully applies and has not for some time. Our debt in the hands of foreign governments in 2007 was 25% of the total, and of that, Japan and China held 47% of that 25%. So we will be going back to China and Japan with hat in hand, with estimates of total debt rising to 70% of GDP from 40% of GDP. That 10 trillion I mentioned in 2007, that was the 40%, but that's going up. And this is not necessarily a good posture for a preacher of reform. Nevertheless, we are right, and we need to negotiate with the Chinese, and one of the carrots we have is this expansion of the role of China, India, and Brazil in global economic governance, possibly working through the G20. The only other country I want to mention is India, and I confess that I have no firsthand knowledge of the country, having never set foot into it. I've not even seen Slumdog Millionaire, so I'm really out of touch. But for our purposes today, just let me refer to India as a case in which decoupling, the notion that national economies were sufficiently at a distance from one another, that, say, a subprime mortgage crisis in the U.S. Could be relatively well contained elsewhere. Now, India's economy is relatively insulated. Only a small portion of their economy is export-related, although exports are growing. And Joe Nocera pointed out in the New York Times, perhaps if we had just lived through a stock market bubble rather than a credit bubble, the decoupling theory might have held up. But equity markets fundamentally depend on the soundness of robust and healthy credit markets. And when those markets falter, nobody escapes. So India's in the soup, just like the rest of us. Will India recover? Yes. Will U.S.-India relations remain intact and grow closer? Everyone I talk to who has firsthand knowledge of India is convinced that it has put isolationism behind it and will deepen its engagement with the global economy in the years ahead. Will India be taking buckets of economic advice from the United States? Perhaps not for a while. Based on what we've covered so far, and in conclusion, what should the Obama administration's foreign economic priorities be in the period ahead, in addition to the obvious one of getting America's economic house in order? Let me just tick off 5 in no particular order of priority. 1, the new administration needs to back off on some of the negative trade policy campaign rhetoric and get behind moves to keep the global trade regime afloat. 2, there's a pressing need to get on with the project of improved global financial governance. 3, the nation needs a credible and ambitious energy policy that at least points in the direction of reduced oil import dependence. You may be amused at this, but when I was working for George Shultz in the mid-'80s, he at least twice approached President Reagan with a well-crafted proposal for a fully refundable gas tax increase. The refund would come through reduction in payroll taxes or whatever. But the key point is to change the relative prices of things in people's minds, and that in itself would have led to vast changes in how we consume transportation, fuels, the kind of cars we would build, and so on and so forth. No dice, said the Gipper. No new taxes. And it's interesting to me that in his memoirs, Schultz doesn't even allude to this episode, but it happened. Take my word for it. Finally, there's the issue of climate change, which we'll be discussing. There is no national solution to this looming crisis, present crisis, I don't know. And 5, harking back to that intelligence report about 2025, we need to strengthen third world governments to prevent a chain reaction of state failures and civil wars. Very clear how to do it, where to get the resources to do it. I'm not so sure. What I've said or laid out in brief or maybe not so brief compass is a daunting agenda, to be sure. So let us wish the new administration well as it tries to come to grips with all of this. Thank you for listening.